Welcome to TheoTrade. This is Don Kaufman doing the weekend update here on October 16th, 2016. First, we're going to take a quick look back at some of the action in markets from the previous week, and then we're going to spend the vast amount of our time looking forward, some different trading ideas, and specifically what we're going to be looking at for the week ahead. I'll start by taking a look at the S&Ps, which saw some precipitous decline, if you will, yet still holding some key levels. Again, this previous week of trade, we had a little bit of volatility out there. If you do look at any daily chart, you're just going to, at a glance, see expanding ranges on an intraday basis. Again, as I said, though, levels held, and the levels that I'm referencing happen to be in reference to the S&P futures. Now, for the past 3 months, we've been talking about very detailed levels. I'll come in here on a 30-day 1-hour chart and kind of discuss those levels again. And these are levels that we have found that the institutions happen to be hedging at these specific levels. Again, we're looking at levels of 2153, 2143, 2129, and down below over here 2112. And we'll kind of zoom into some of the recent trade. They've acted, like inflection points in the marketplace, literally stopping, reassessing, and bouncing between these specific levels. As I said, levels held were just under 2129, which is a really key inflection point. Any trade down to the 2112 handle inside, again, this is the S&P futures, any trade down to the 2112 level in this coming week would mark a really chaotic kind of change in terms of volatility. Every time we've actually traded in and around the 2112 inside of the last 3 months, and again, you have to go back all the way to July to see some of the trade out there, the volatility is kicked up, volume size out there becomes extreme. Breaking below the 2112 can only be described as a break lower in markets, which is something I want to look at with this last week of trade. So we'll come off the level discussion here just a bit, which I will cover levels a lot more during the course of this week, as again, these levels have just acted as inflection points where we've gone long and short on an intraday basis. There's something, I guess, much more exciting going on in markets that I don't think a ton of people are looking at, and I'm going to start with one idea and we'll kind of move from there. So this past Friday, we saw the likes of many of the financial stocks release earnings. Your JP Morgans out there, Citi, Wells, they released the earnings, generally speaking, beat expectations. And again, I don't want to throw out too much of a blanket statement, though. JP Morgan, decent numbers, Citi, Wells recovering, from the scandal out there. Nevertheless, the tide appears to be turning on good news. Why do I mention that? Well, if you take a look at something like JP Morgan and the range that it traded, on Friday, we traded up to the 69 level. And again, I'm going to actually go to the intraday trade. They faded the stock not only on decent news out of the earnings announcement. And I say they faded the stock. It sold off throughout the course of the trading day. You saw the exact same thing inside of Citi. Got hit hard throughout the course of the trading day. Again, still ended up, but this is a stock that had fairly substantial positive news. And that's not necessarily what kind of caught me as unusual. What's unusual is your financial stocks faded, on good news, but good news didn't do it. It was actually the bonds selling off. Now, the bonds happened to sell off on some comments out of Janet Yellen. A bond selling off, inversely, interest rates go up. So let's take a quick glance over at those interest rates. For that, I'll go look at the TNX. So this is the TNX, which is the 10-year Treasury Index. For the most part, the TNX says 17.94. That references about, a 1.79 interest rate. So roughly speaking, it's about a 1.8%, all right, interest rate associated with the 10-year. Now, if you guys know a bit about the interest rate component of the bond market, typically speaking, when interest rates go up, it should be very, very positive for financial stocks. However, if you take a look at the XLF, and the XLF is a the prime candidate, it is your financial sector. Take a look at the XLF. It initially reacted very well to the increase in interest rates. And as I said, the tide turned against the financials on Friday in what can only be described as the bonds breaking down. Highly unusual, and you really want to watch this in the coming week. Is this going to be the norm where we're, again, all of a sudden interest rates start rising? That should be good for the financials. And yet the financials back off, and in a big way. Again, if you hadn't looked at the trade on Friday inside of the financials, very similar. They whacked the entire sector and sold it off very early in the morning. And as the day progressed over there, it was the financials that actually brought the S&Ps back down to massively unchanged by the end of the trading day. Now, to be a little bit more forward-looking, if you take a look at the financials for this coming week with 5 days remaining to expiration, again, all we're doing is looking at the options in this forward week, you'll see that there's about a 46-cent expected move, slightly elevated implied volatility. Why? Because you still have Bank of America that's about to release their financials out there, come early in the week. Nevertheless, the financials are the product you want to keep your eye on this week. If the S&Ps are going to break lower, they're very likely to do it, right, on the financials breaking lower. So the financials have really been kind of on the forefront. It's a sector that's been moving markets as of late, and we're going to keep a very, very close eye on these financials, again, which they started to descend on, good news. And it's one of the first times we've seen that in quite some time. Again, all eyes on the financials, especially early this week. Now, there's one other thing I want to bring up when we're discussing the financials, and this is something I've talked, quite substantially about recently. Efficiency in the markets right now, okay, is incredibly, and it's just a phenomenal, occurrence of efficiency in the marketplace. And what am I actually saying when I say efficiency in the marketplace? And I'll come to that here momentarily, but I'll start by the S&Ps. What we're actually seeing in terms of efficiency in the marketplace is, for example, here is a Monday option. And this Monday option, well, it's going to expire at the end of Monday. And there's pretty good volume here in the SPX options. In fact, I'll close up this Monday and I'll cruise down here to the bottom of the screen. You look at today's option statistics. This happens to be, last Friday's closing volume. This is the volume of contracts that was done in the SPX, and it's trading right around 1 million contracts. Now, if you're unfamiliar with this, the entire marketplace, in terms of options, the entire marketplace did about 16 million contracts on Friday. Well, 1 million of those contracts were done here in the SPX, which is not unusual. So what you're initially thinking to yourself is you're like, oh, great, I get it, Don. What you're saying over here is that for the most part, 1/16 of the volume in the entire options business is being done right here in the SPX. No, far from it. Why? Not only the S&Ps trade heavy volume, the spiders trade heavy volume. You have to agree that the spiders and the S&Ps are probably going to move in relative tandem. The Qs trade heavy volume. The IWM trades heavy volume. But here's the interesting thing. This is 1 million contracts that traded, which is 1/16 of the overall volume in the entire marketplace. Yet the average contract size, it's on a $2,000 product. The average contract size is a magnitude of what? 20 times larger than your individual stock, right? So if you look at something like Apple, and I'm going someplace with this, so hang on. If you look at something like Apple, it traded 600,000 contracts. Yeah, but it's 600,000 contracts on a $117 stock versus the SPX, which ultimately has 1 million contracts in a $2,000 product. So the size of the trade in the SPX is going to move the entire marketplace because there's billions, okay? In terms of what we call notional value, that's the total value dollars at risk. If you were to actually calculate on a $2,000 product times a million contracts, it's a magnitude, okay, that really accounts for most of the liquidity inside of the entire marketplace. Now, back to the one-day options, why they're so important. If you look, tens of thousands of contracts are now trading here inside of the weeklies with 1 day remaining. The efficiency that I've talked about, and it's the efficiency just, when I say it's phenomenal, it is uncanny. If the expected move, which is the option pricing, if the expected move says $14, watch the market throughout the course of the day. It'll literally move $14, stop on a dime, okay? Make sure everybody's hedged off, and then possibly reverse from there and or continue. But watch the expected moves because they have been, as I'm saying, spot on a day-to-day basis. And I can't stress this enough. And if you haven't gone back, do your own homework on this front and go back. You know, if you're on thinkorswim, great. If you're not, don't worry about it. But I'll actually display a little bit of this to you, okay? Go back a few days in trade, and, you know, here we are on October 16th. But if you go back, for instance, to the close, if you will, all right, on Thursday. So here we are again. All I've done is just backed up the date, okay? And again, we've gone back in time. Just see the closing prices on Thursday. Anyway, we were expecting about a $14 move on, you know, a last price on Thursday of $21.32 and change. So for the most part, if you add like 14 and change to that, you know, you come out to, all right, we shouldn't move much more than what? 21, you know, 40, what? 647. We'll go back to the trade tab over here. Now this was Friday's data. We moved to 21.49, stopped on a dime and reversed off of it. Now, all right, that's one product. It exceeded it by like $1 on an intraday basis and reversed off of it. But if you take a look at something like the XLF, and we'll go to the Analyze tab here in the XLF. Now we're looking back, again, Thursday's closing data. So this is projecting what the Friday move is supposed to be. The Friday move, according to the option pricing, is supposed to be about 29 cents. Now that was a what? A $19.33 product. So you take $19.33, you add roughly what? 30 cents to it. So we shouldn't go much beyond what? Oh, about $19 and what? 60 what? 3 cents? $19.63 is the upside of the expected move. So let's go back to the trade tab and let's look at Friday's pricing. So here's the last price, okay? Bear with me over here. Yeah, I'm going someplace with this. Look at the high in the day. Do you think that's just, you know, coincidence over there? That you get some of the largest products with some of the largest liquidity. They're moving literally to their expected move. And it has to do a tremendous amount with the hedging activity that's persisting in the markets. That's exactly how we're also picking out these levels. It's all about hedging activity right now. And the reason that the markets have become so incredibly efficient, the entire reasoning behind this is all the volume, okay, of options, of futures contracts, all that volume is inside of the S&P product. Meaning that, sure, stocks like Apple are trading some volume, but we're seeing, so Apple traded, you know, 623,000 contracts going to Amazon. Amazon did 125,000 contracts go over to Facebook. Do you realize that there's only a handful of products? Like you can actually count, all right, pretty much on one hand the number of products that are seeing almost all the order flow in the markets these days. So there's this concentration of liquidity into a handful of products. You know, even the XLF did 159,000 contracts, but the biggest one, if you account that there was only 16 million contracts, and that's about average, about 16 million option contracts trade a day. You know, the spiders did almost 3 million of those contracts, and the SPX did the other million. So right there, you're already at 4 million contracts, which is what? 1/4 of the volume that's been done in the marketplace. And we already know that the SPX contracts are 10 times larger pretty much, or 20 times larger than any other product out there. No wonder the markets are actually moving to these levels, okay? Because there's billions and billions of dollars that are all being traded right at these expected moves over there. So the S&P futures are used to hedge the SPX, hence we stay within these expected ranges. Now, it's great for the time being. It's great for the time being because as you move forward into this next week, there's not a huge amount of news coming out this next week, all right? Coming to Thursday morning, and again, I'm projecting forward now to the coming week. You go over to the calendar over here. There's one announcement that could rock markets, and that's going to be on October 20th. It's the ECB announcement. All right. You can look at housing starts. Sure, it can have an impact to markets. Bank of Canada. Yeah, I don't think that's going to do very much. Nevertheless, the ECB, Mario Draghi. Well, we call him Ivan Drago here at TheoTrade. Nevertheless, the ECB announcement's kind of the bigger announcement on the week. Not much else to go off of. However, there's, earnings kicking into full swing. Nothing huge, though, projected to come out with earnings. You can run like earnings scans over here and, all right, Wells already released, so you got Bank of America up. It's really this week we're starting to see some good amount of earnings. Obviously, we've got Netflix coming out. Oh, the excitement. It's not that exciting. When you have like a $35 or $40 billion company, it's not really going to be a market-moving event out there. Intel could obviously move markets. IBM, again, smaller market cap these days. Nevertheless, earnings, although they're in full swing, they really are not this coming week. They're the week after that when you start to hear from some of the technology titans out there. Nevertheless, as the week progresses here, keep your eyes on these levels. Again, this is the levels that ultimately have been huge inflection points in the markets. Okay, there is evidence that we're starting to break apart a little bit. The tide has absolutely turned against good news, and it's the first time we've seen that in a very long period of time. That again, those financials, they had decent news. Interest rates, are helping out the financials, and yet they still happen to break lower. So as the week progresses, a few products that I would watch very carefully. Bonds. Okay, got to look at the bonds over here. Listen, these things have been on a one-way ticket to the downside. They broke heavily lower on Friday. Is there a degree of support out here? Well, right now, you might argue, all right, it's the 61 level. Listen, we already broke numerous levels inside of the bonds. They're a one-way ticket to the downside, which could take interest rates higher. Interest rates going higher should help the financials. Yet, the financials, okay, didn't fare very well. But interest rates exploding higher, that is if the bonds sold off hard, interest rates exploding higher, could definitely hurt every product on the street. The bonds continue to sell off. Look for the broader S&Ps to actually sell off. Now, here's the most interesting thing is that, again, if we start to break lower throughout the course of this week, could we even see the bonds reverse and rally back up? Because what we haven't been able to really ascertain is if the markets, the S&Ps, really start to sell off hard, where is money going to flow? Think about that for a second. You think it's going to gold? I don't. I don't think money is going into gold. Why? Because if the market sells off hard, the dollar might rally. If the dollar rallies, it'll actually throw, a nice ice bath over the gold party over there. It's like bringing a wet blanket to a party. Nevertheless, you got to watch the dollar if you're going to be involved in gold and or oil at all. The dollar is also trading out in what I term like no man's land. There's no, upside resistance over here. Like people will point out, oh, back here is at 98. Listen, one-way ticket to the upside. The bond's been a one-way ticket to the downside. It does appear, okay, that we're about to really enter this phase of heavier volatility. Okay, don't sit back and, think that the election, I got to wait for the election to happen over here. That trade is about over and done with. Last but definitely not least, the volatility of the volatility index, the VVIX, remains in a highly elevated state. displaying that we're right at this inflection point for heavy risk coming into the markets. Stay tuned throughout the course of this week here at TheoTrade. I'll be discussing a lot of levels in the S&Ps as we move forward. Thanks everybody for joining us here for the weekend update. Have a great weekend. Bye-bye.